Today I want to analyze Target Corporation, one of the largest retailers in the United States with around 1,978 stores across the country. Target is especially popular among women and families with its 45 private label brands. So when we're going to take a look at the stock price, we can see we are down around 22% in the last 6 months. And we're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize is the market cap around 56.83 billion US dollar. This makes Target the third biggest supermarket chain by the market cap. We can also see we have a dividend yield around 3.52%, and they did increase this dividend 58 years already in a row, which is really incredible to see and is in a good rate as well. Now we're going to take a look at the financials. The first thing we are looking for is revenue growth in the last 5 years. Because we want to invest in a growing business and not a declining business, we can see here the revenue in 2020 was around 78 billion US dollar. Then we had the strong increase around 20% in 2021. Then again, the strong increase around 13% in 2022. And then in 2023, around 3% increase. And then in 2024, we had a decline in the revenue around 1.57%. So overall, it's a really good increase in the revenue, and we like to see that, especially in 2021 and 2022. Of course, now we have a decline in 2024. This is something we don't really like to see, but if the company can increase the revenue in the future again, I think it's looking very good. The next thing we're looking for is free cash flow growth in the last 5 years, a very important number because the free cash flow can be used to pay the dividend, to pay the stock buybacks, to invest in the business, or to pay back the debt. So we want to see that grow. And we can see here in 2020, the free cash flow was around 4 billion US dollar. We had a strong increase around 66%. Then in 2021, we had a strong increase again around 92%. And then in 2022, we had a strong decline around 35%, which is understandable because we had a strong increase in 2021. So it's understandable that it can decline a little bit in the next year. But then in 2023, we had a negative free cash flow around 1.5 billion US dollar. And then in 2024, we had a strong recovery around 3.82 billion US dollar. So overall, we didn't have the crazy growth in the free cash flow, so it's not a check here. But we can also see here, so operating cash flow wasn't negative in 2023. So overall, I think the reason for that was boycotts of this company. We had some boycotts, and we can see as well, we had the strong capex in 2023. It was higher than in 2021 and 2022. So overall, these are the reasons I would say. But we need to see if this company can grow the free cash flow in the future again. The next thing we're looking for is the free cash flow yield over 4%. This can also indicate if the company is undervalued. So if it's under 4%, it can mean that the company is overvalued. So what we're going to do is we're going to take the free cash flow in 2024 around 3.82 billion. Then we're going to divide it with the current market cap around 56.83. And then we're going to get the free cash flow yield for 2024. So the number we get is around 6.73%. So this is a great number. It's over 4%, so it's a check here. And I think it can indicate that this company is undervalued right now. But what we also can say is we have a dividend around 3.52%. And we can pay this dividend with the free cash flow. There's no problem. And we also have money left that we could use for stock buybacks or to invest in the business. So overall, this is a great number. The next thing we're looking for is debt to free cash flow ratio under 5. This means the company can pay back the debt with a free cash flow in under 5 years. A very important number as well, because if a company has too much debt and cannot pay back the debt, it can risk to go bankrupt. So we don't want to see that. So we're going to take a look at the short-term debt first. We can see here around 3 billion. Then we're going to add the long-term debt as well, around 18 billion. But I think it makes sense to use the long-term debt excluded capitalized leases. So it's around 13 billion. And then we're going to divide it with the current free cash flow around 3.82. So the number we get is around 4.18. This means in a little bit over 4 years, we can pay back the debt with a free cash flow. This is a good number. It's a check here as well. And we can take a look at the cash on hand as well, how much money this company has in the bank. A little bit over 3.8 billion. So this is also a good number. It can mean they can pay the dividend or to invest in the business or to buy back their own shares. So that's really good to see. The next thing we're looking for is enterprise value to free cash flow ratio under 25. So this can also indicate if the company is undervalued. So the lower the number, the more undervalued can the company be. So we're going to take the enterprise value. This is the current market cap minus the cash on hand plus the debt that we have. So this number is around 69 billion. Then we're going to divide it with the current free cash flow around 3.82. And then we're going to get the ratio around 18. So this is a great number actually. It's under 25. And this can indicate that the company is actually undervalued if we compare the enterprise value with the free cash flow. The next thing we would like to see is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. This can help the stock price to increase. And we can see here, Target did a lot of buybacks. We can see here, especially in 2016, close to 9%, but in other years, over 4%, sometimes over 3%. This is a great number, and I think they can afford it. They pay a dividend around 3.5%, but they have a higher free cash flow yield, so they can afford to buy back their own shares. I want to give my conclusion about this company. So let's start with a positive. So we had the revenue growth in the last 5 years. This is great to see. We also have a free cash flow yield around 6.73%, which can indicate that the company is undervalued right now. We also have the enterprise value to free cash flow ratio around 18, which is also a great number, which can indicate that the company is again undervalued right now. Then we have the dividend yield around 3.52%, which is also growing many years in a row. And I think this is a great number as well. We have a good balance sheet with a low amount of debt and a good amount of cash on hand. But the negative would be the free cash flow decline. We had a negative free cash flow in 2023. This is something we don't like to see. But overall, if this company can grow the free cash flow again, I think it's looked very undervalued right now.